All right, everybody, welcome. It's time to talk about business organizations. What type of ownership do you want to have as you set up your business? And so today we're going to have a conversation with Professor Brad Cripe, a friend of mine for multiple years, if he chooses to admit it. And then ultimately, I consider him my tax guru. One of the things we believe is kind of underrepresented in these discussions is the idea of the tax implications of the different choices. And so, Brad, tell us a little bit about your background and um, why you got selected to be in this conversation.
Well, good. Well, thanks, Tim. I appreciate it. I'm Brad Cripe, and I am a professor at Northern Illinois University. I'm the assistant department chair. Before I went and got my PhD at Nebraska, I worked for KPMG. Worked a couple of years in an office in Texas that is now closed. So I don't know if that's any
Well
indication
done. Well
of
done.
my abilities or not. But I worked in U.S. Federal tax as well as some international tax on the border between Texas and Mexico.
Well, that was the
And
right place to be. Still
it,
is.
yeah, and so I did that for a little bit, but I love to teach and I love to talk, and this was the perfect opportunity for me. And Tim and I worked together for probably 5 or 6 years. I was
Easily. Yeah.
yeah, and we've known each other for even longer. And so I'm super excited to be here today and talking about business organizations.
Yeah. So I don't pretend to know, lots of stuff. I know my little area, but this is one where I don't. And so you might as well fess up, say I don't, and we'll let somebody that does talk a little bit more about this.
I'll do my best.
So ultimately, I think whenever you have these discussions, people talk about these three general types of structures: the sole owner, the partnership, and corporation. I mean, if you want to get fancy, a lot of people will call it sole proprietorship. If you just like bigger words. But nonetheless, those are kind of the general structures. I'm not, Brad may talk a little bit about limited liability corporations or those things just in passing because they do have uh, some certainly some implications for the way that your legal liability issues and some tax implications. But ultimately, we're just trying to stay within these three general buckets. A couple of things to think about before we get to the tax implication part, because this is the Brad world. Brad's world. And so, you know, what's the level of setup? How much do you have to put into it? Who's actually controlling it and making the decisions? How do I generate the greatest amount of liquidity and get my cash flows together? What do I see as the need for growth? And then a little bit of of legal liability, and then we'll talk about some tax implications. And so we've got these comparisons, but ultimately, I think one of the things to think about, and it's difficult to think about the tax implications when you're so enthusiastic about your starting your business and your new idea and those kind of things. Tax may be the last thing on your mind, and you may get yourself into a little, a bit of a bind
Sure.
when that happens. So, Brad, take it over. Tell us a little bit about. Why don't you start with the idea of a sole owner,
Yeah.
and what are the tax implications that you see when you talk about that?
Well, thanks. Well, one of the things that I think Tim brings up is that tax may be the last thing on your mind when you're thinking about these things, boy, but that really gets you into trouble. And so the government, when it will assign you a entity type if you don't assign one to yourself. So
Oh,
as soon as you start generating income, you will either be defaulted into one of these three buckets or you will select it. So, for example, if you decide that you want to do an Uber driver, if you want to be an Uber driver, and you just get in your car and start doing that, you have a sole owner business in the eyes of the government, whether you choose that or not. The government doesn't the government believes that if you don't choose an option and you're a single owner business, then you're a sole owner business. And so you have to be careful in that if you earn income under that sole owner umbrella, then that's how that is going to be reflected on your return. Even though you may want to be incorporated, if you're not incorporated, you are a sole owner business if you're a single owner entity. So that's kind of the first thing.
Well, I have one question,
Yeah.
and this I think is illegal, but I'm going to ask it anyway.
Okay.
How do they even know I'm generating income?
Oh yeah. So that's always something that I'm asked is how are they going to find me? I mean, after all, I'm only making $1,000 or $2,000. You know, it's my family always asks me that question. And a couple of ways they can find out. Number one, Uber is going to send information to the IRS. I'm sorry, my dogs are
It's
barking.
all right.
Uber is going to send
Your dog
information.
doesn't want to be an Uber driver. That's all I can tell you.
He has other things he wants to do, but not that. But Uber is going to send information to the government about how much it pays you. And if you don't properly report that, then the government's going to wonder where that information, why that's not on your return. So that's kind of the first thing. But also because frequently we get audited for other things, small things, maybe a transposed social security number or some other thing on our tax return. And while the government's going through and digging through that, it finds this. It goes to your checking account and sees these deposits that you can't explain. And so there are many ways the government can, if it's looking, can find out what you are doing. And then you're in trouble. And then they start looking for other things, and then it just never goes away.
Okay. Yeah, that never goes well.
No, it doesn't. So if you have this business and you start it, one of the things you have to worry about are potential deductions. So the way the government operates, the way the code operates, is that income is taxable unless you can prove otherwise, and no deduction is allowed unless specifically authorized by the code. So as I'm thinking about tax implications, any income that I receive from being an Uber driver, for example, is going to be taxable unless I can show that it's not. And my deductions for depreciation on my car, gasoline, those kind of things are not going to be deductible unless I have things like receipts, unless I have documentation. And if I'm not keeping that, if I don't have a business mindset to keep things like receipts and accurate records, then those deductions that I'm legitimately allowed to take are going to be denied. And so the implication of making sure that you are minimizing your tax liability legally is something that a lot of sole owner businesses just don't understand at first because they're so into making the business work. And I appreciate that, but if you're going to lose your business, one of the main reasons is because you can't afford the taxes, or you're not doing the documentation necessary to keep your business.
And that could be multiple kinds of taxes. It doesn't have to be federal.
It
could be state, and certainly payroll taxes come back to get you probably quicker than anything.
And payroll is huge. If you have employees, you are taking it to the next level in terms of tax implications. You really are. You're reporting every 3 months, and you have a lot of additional compliance work that goes into that. So employees are a big step. And even if they're your family, it's still a big step. And so just be careful of the impact of being an employer. So for example, in a sole owner business, you and the business, according to the tax code, are linked. You are the same entity. So the entity is not separate from you. You are the entity, and you file this income statement. Basically, it's called a Schedule C. You might have heard of that, but it's an income statement for your business. And but you have earned the income yourself. There's no entity between you and the business. You are the business. And it's designed that way to make it easier for you to report your income. Certainly designed that way to make it easier for the government to hold you accountable if you're not doing what you're supposed to be doing.
So in this case, that is why we also have the biggest personal legal liability in in this situation because we are considered the same thing.
Yes.
You can't separate me out. So a couple of things I would take out of this one that you're saying is, um, make sure you have a plan for record keeping. You know,
Yes.
that's not necessarily saying that, you know, in this course, we'll talk about the accounting side, but you've got to have a plan. You know, if it's nothing else than Quicken of some sort, make sure you've got a list of receipts and you separate the ones that are personal versus the ones that are associated with your business. And that blurs
Oh,
because you hear people say all the time, right? Oh, I can just deduct that because it's part of my business. And
yes. Write that off. I'm going to write that off.
yeah, that's the best phrase. So yeah, you don't have to worry about that. Just write it off. Well, move on over to partnerships. Tell me a little bit because I've been part of those in different
Yeah.
situations. Some have worked out, some have not. So what are your thoughts on that one, Brad?
Well, I really like what you wrote about the words deceptively easy to set up, because you can set up a partnership and not even know it. So,
Oh,
for example, let's say that you and a friend, you're not married, but you and a friend decide to buy a house together, and you do, and you're on the title, and it's got 3 bedrooms. You have one, your friend has one, you have a third one, and you guys decide to rent out this third bedroom just because you need to make a little money. Well, you do that, you start generating income. Well, guess what? You have a partnership. You and another person are co-owning real estate and generating income. And so you don't even know it, but you have formed a partnership. And
so
so
this idea of co-ownership is the key here.
yes, if you own a piece of property or any asset that generates income, and you're not married to that person, you're not filing a joint return. And even if you are, if you both own the property, then you essentially both have to take a responsibility for that income. And
Okay.
so you have a partnership, and there's a lot more reporting, a lot more tax compliance that goes along with the partnership, because that entity has to file its own return. Now, there's a big benefit to the partnership form, and there's sort of a big curse, right? Every benefit in the code, every benefit the government gives you, it has a curse. The benefit is that partnerships never pay federal income taxes. So they are not, um, they file returns, but a partnership is basically a picnic basket where it assembles all of the gains and losses and income and deduction of the business, and it holds those, and then partners come in and pick out the income and expenses that they want to report on their return. So when you go on a picnic, certainly the picnic basket does not eat your food. If it did, you have a weird picnic. But all the food has to be eaten. That's what I always tell my students. If you're going on a picnic, your partnership is your picnic basket. But the difference is all the food has to be given out to the people on the picnic by the end of the picnic. And so
And different
that's
people can get different amounts.
they can right. You can arrange this very complicated, and Tim could get all the gains, and I could get all the losses. And there's a lot. I mean, I don't want to go into any sort of
Yeah.
the technicals, but if you'd like to, I'm sure there's a class that you could do that in. But
Not mine.
not Tim's. But I will say that that's a huge benefit. The
So
cost,
what's the curse?
the curse is that you have to pay taxes on this income, whether or not you take the cash out of the business. So there's a big difference between income and cash flow, and you are going to be assigned income from the partnership as the partnership agreement specifies. And you got to pay tax on that income, whether or not you get take any cash out of that business. And so there can be huge cash flow implications,
Okay.
huge cash flow implications here. So you have to watch that. Record keeping is far more serious here because the partnership is filing its own tax return, and it is responsible for making sure that it allocates that income properly. So much like you might get a W-2 from your employer for working, you get a much more complicated form called the Schedule K1 that has a lot of boxes and a lot of information on it. So if you're a partnership, you are going to need some professional help just to make sure you are dotting the I's and crossing the T's and not getting into trouble.
Yeah, that one is this kind of hybrid thing, and it can sound like we said, deceptively easy, but it can come back and really get you in a hurry.
Yes.
Not to mention the side of the house where partners certainly can disagree, and then it becomes even uglier when we
Yes.
start looking at how do we take the picnic basket and start taking apart for pieces.
I want the handle.
Yeah, I got the handle. Well, tell us a little bit about corporations.
All right.
That's kind of where I don't know how many businesses start straight out as corporations, but certainly is kind of the transition. That's kind of the arc
Right.
of a lot of businesses. So tell us a little bit about this in terms of corporations.
So a corporation can have as many owners as it wants or as it needs. So you could certainly have a sole owner business. That's a corporation. You might start as an Uber driver, and then you get bigger and you want to incorporate it. So the incorporation requires an act on your part. You must go and become a corporation in the state in which you desire to be incorporated. So you're not going to accidentally form a corporation.
Yeah,
You're
it's not
going
going to default. It's not going to default.
Right. And corporation is at the state level. So you can't incorporate at the federal level. You incorporate at the state level. And then you have to abide by the state laws in which you live. The Secretary of State is normally the entity that you go to. And so when you incorporate, then you transition into this corporate form. And there can be tax implications to doing that, because most likely you've generated some income as a sole owner business or some income as a partnership prior to this form of the corporation. And so there are some legal issues in jumping to the corporate form. But the main advantage of the corporate form, number one, is you certainly have this legal protection. The downside is, from a tax perspective, you're going to pay taxes twice, with one exception. But the normal, what we call Schedule C, Subchapter C corporation, is that the entity will pay taxes, and then when it distributes income to you, or distributes cash or property to you in the form of a dividend, then you will pay taxes on that dividend. There is a form of incorporation called an S corporation that acts like a partnership, where there's only one level of tax generally. But the standard corporate form is that you pay taxes on twice. The corporation pays taxes on its income, and then the shareholder pays tax on the dividend that it receives.
So the only two ways really that you can get cash or whatever out of the corporation, they could pay you salary.
They could.
Or they could issue a dividend. And the temptation is to make everything salary, because then it's deductible to the business. But there's a curse to that, right, Brad?
Well, certainly there is an opportunity to play games. So you want to, one of the things that my students don't often understand is that when you file a tax return, you're asked to give a 6-digit code, and it is the business activity code. And what the government does is it checks your information against every other business that files with that number. And if you're paying yourself too little salary or too much salary because you're trying to play a game, then the government can come in and reclassify payments to you that were salary as a dividend, or dividend payments to you that were salary. Dividend payments are not, you don't have to pay payroll taxes on dividend payments like you would salary. And so it can, there are areas here that unscrupulous accountants or people who are trying to avoid taxes can really play games, and you want to be careful with that. So if you're paying yourself too much salary, which is usually not a problem, usually you're not paying yourself enough salary.
Yeah, that's right.
it can be an issue, especially with that S corporation that I talked about earlier. So if you incorporate, you're essentially really expanding out the amount of compliance work that you're doing, because that corporation now is a separate legal entity in the state. It is subject to all of the responsibilities that a legal entity would have. It has to file a tax return. It can get sued. It can have issues with liability itself. And the government tracks that, and it has to be dissolved as well. It is much harder to get rid of a corporation than it is a sole proprietorship. So the idea that you must incorporate is something that that I think is an issue that you should think about before you do it. And just because you incorporate doesn't mean that you have the protection of this legal entity. If I run a corporation, but I'm doing something wrong or I'm hurting people, just because I'm incorporated doesn't mean that I'll lack that legal liability. I can be sued personally, even if I have a corporate shield, if I do something wrong. So be mindful of the entity choice that you choose, the advantages and the disadvantages of those entity choices, the cost of them, because you don't want to be paying all of your profits to lawyers, but you also want to be sure that you're choosing the right choice for the entity that you have and the time in its life, you know, when it's maturing versus when it's starting.
And when you want to transfer ownership.
Right.
And so I think that this life cycle idea and the different positions when you think about ownership is an ideal transition as we finish up here, because the bottom line for me when I think about these things is what's right for you in your situation. But the important piece, ripping off a sappy movie about football, you need to protect your blind side. So find yourself a good left tackle. Sometimes that's your attorney. Sometimes that's your a CPA. Sometimes that's a friend, whatever it might be. But find yourself a good left tackle. Well, Brad, thanks so much for spending your time with us this morning.
Thank you.
And he's getting ready to go to a faculty meeting, so that can't be good. But nonetheless, I'm going to shut this thing down now if I can make it stop. And so, Brad, thanks again. I hope you guys found it informative. We'll see you guys in class, and Brad, I'll see you on Zoom.
Thanks, buddy.
All right. Take care.